Sir, you are live now, and we welcome you to today's session on transfer pricing, the basics. Over to you, sir.
Okay. So good afternoon to all. I am Dr. P. Sivarama Prasad. I am former Assistant General Manager from India's largest bank, that is State Bank of India. First of all, thanks to Committee on Taxation for giving me an opportunity to discuss about the basics of transfer price mechanism in foreign trade, particularly DT purview. So today, on account of that globalization, world is single market. Even though there is a boundaries are there among the countries, but market wise, there is no boundaries. So that's why the trade is happening freely for different countries, whether it is in imports or exports, etc. etc. Not only that one, within the country also, different states, they are imposing different types of taxes. Some of them on account of a backward districts or backward states, they are offering a less tax when compared to the developed states also. To develop that backward states, government is offering some tax concessions. At the same time, the developed states, they are not offering. So here, the differences are there within the country or cross border of the countries also. So that's why the transfer mechanism system is arise. Otherwise, the transfer price mechanism, if at all people are following, particularly the promoters or the business entities are following the correct guidelines, then the transfer price mechanism, the word will not arise. So different, particularly this transfer price mechanism, the cost accountants are well versed in this subject. So today's topic, I will discuss in depth only a view, general view, and subjected to approval. I will discuss the various methods and how to audit, what type of returns are to be submitted to the CBDT. All these things subject to approval of the committee. I will discuss the same in the coming classes. First of all, for any class, whenever we are spending time, efforts to listen all these things, what is the opportunity? Why should I learn? What is the useful of this topic? Mr. Prasad is telling something about the topic. What is the usefulness in particularly in my practice? That is very, very important. Whatever the knowledge is, that is to be translated into opportunities. So the market is big in India. Our country is population is also high when compared when compared to the other countries. Here opportunities are also plenty, but opportunities are not visible. It is invisible. We have to search, we have to scout, we have to scan the opportunities and avail the opportunities properly. Because being a largest country, that too highly populated country, opportunities are n number of opportunities are available, but it is not visible. That's why we have to put the efforts to avail the opportunities. In the similar manner, transfer price mechanism also, particularly in foreign trade transactions, opportunities are available for the cost accountants. If you see the India's exports, particularly the merchandise and service, whatever the manufacturing sector, whatever the service sector is there, both are year on year basis, it is increasing both the exports as well as import side. But at the same time, balance of trade negative is also arising. Take for example, India's export merchandise services April to November 2023 is USD 499.46 billion. At the same time, imports also April to November 2023 estimated is 560.90 billion. because they have not arrived the conclusion. That's why they mentioned estimated. This figures are announced by the latest figures announced by the Minister of Commerce and overall trade during particularly November 2023. This is the figures. So world is a single market. That's why to develop the country, the exports are very important. At the same time, to manufacture the export products, imports are also very much required. If you see the companies, particularly the companies, corporates, those are registered with the Ministry of Corporate Affairs. As on 31st October 2022, total is 24 lakhs 20,775 companies are registered with the Ministry of Corporate Affairs. And out of that, active is inactive is also there. So the active companies are 14 lakhs 92,015 companies are active, comprising of the private sector, private companies and public companies. The private companies are 14 lakhs 21,002 as well as the public companies 71,003. This is statistics they announced by the Minister of Corporate Affairs. And if you see the majority of the active companies, that is 80% were operating in activities covered under 5 broad heads. Before going into the subject, we have to know how much potentiality is there for this transfer price mechanism. For that, the data is also very, very important. Take for example, business services, 30%, manufacturing, 21% of the total companies, trading companies, 13%, community, personal and social service type of companies, 9%, and construction companies are 8%. Out of the active companies, about 80%, the operating activity wise, the segmentation of the companies. Because here, this segmentation is also I have to know. Then only I can avail the opportunities, particularly business services. If you see the business services, 30% are there. Out of a business services, what type of service companies are there? Hardware and software consulting companies and data processing companies, research and development companies, legal, accounting and audit service companies, and business and management consultancy companies and advertisement companies. All are comes under the business service. That is the out of the active 30% are business service companies that are registered with the ROC, various ROCs across the country. Not only that one, manufacturings. The manufacturing companies are various types are there. If you see that particularly manufacturing, 21% out of the active companies. And this 21% consists of food processing units. Companies are there. Textile companies are there. Paper companies are there. Metallic and non-metallic mineral companies are also there. Chemical and petroleum chemicals companies are also there. Radio and now the media is also active. So many companies are coming under media and particularly the radio, particularly the FM radio and other companies. Transport and equipment is also there. All are comes under the manufacturing includes. This is a bifurcation made by the Ministry of Corporate Affairs. And if you see the foreign companies in India also, 31 October 2022, the registered companies are 5,081 foreign companies are registered under Companies Act 2013. Out of that, that particularly 3,291 companies are active companies, the foreign companies. And during that period, particularly December 1st, 2021 to October 2022, new companies are also originated, 55 companies registered under Companies Act. This is the potentiality of the companies where we are going to handle the transfer price mechanism, whether it is an audit or verification or uploading of various returns, all these things are the potentiality is this much potentiality is transfer price mechanism. What is a transfer price mechanism? Suppose the legal, financial, accounting aspects of highly complex. It is a complicated one, complex one, and global implications are also there. If at all my goods are moving from one country to another country, the tax different types of taxes, the variation in taxes are there. Not only that one, the CMs are getting the CMS cost and management accountants are getting acquainted with this knowledge. If you are having this knowledge, good knowledge, the opportunities are also available. And the practical implications, how the companies are transfer price mechanism, one parent company to subsidiary or associates are located in other country, within the country and outside the country. And the law, what is the law? What is the direct taxes? What is the company's current country's law, which is affected the transfer price mechanism and the rules relating to the transfer price? All these things, if at all you are aware, then only the opportunity will arise. If at all I am expert in this area, definitely some opportunities, definitely it is available. That's why I told about opportunities are not visible, it is invisible. The cost and management accounts being an experts in arriving cost of production. Our subject, a core subject is costing. Whether it is a production or services, we are the better person to arrive the costing. Because our subjects are also like that. So that's why experts in arriving cost of production, operations of various products and services of the companies, and it is imperative for them to understand, appreciate, and develop expertise. It is required because once the transfer price mechanism is there, you are well versed, particularly in the case of cost of manufacturing or services, whatever the cost arrival, they arriving the cost for various entities. You are the best person on various dimensions. So that's why this transfer price mechanism is more suitable for you to arrive the conclusion, to they argue with the regulators, all these things, so as to guide corporates and consultancy. Today, the consultancy services are very much required in this area, whether within the country or the cross-border transactions, particularly the trade transaction. So that's why this subject is the useful. That's why today I'm giving only the elementary nature of the potentiality and the basics. That's why the title is also basic. Today theory. And if at all the taxation committee permits, then we will discuss how to audit, how to upload the documents, various documents with regard to transfer price mechanism, particularly in the foreign trade duty purview. What is a transfer price? Before going into the subject, we have to analyze what is the transfer. Take one example. Example of transfer pricing. Suppose three companies are registered under one group. Under one group, three companies are registered. One, the parent company name is Global Computers. The second, the subsidiaries or associates, whatever the name you call it, manufacturing, Global Manufacturing Incorporation. That is a manufacturing company. The third one is a global distributor, the distributor company. So under one group, the company is a computers company. There another company floated, that is a manufacturer, they will manufacture. Another one is a distributor. Everybody knows that profit is equal to transfer price minus manufacturing cost. Simple. Profit is equal to the revenue minus cost. or price minus cost or selling price minus cost. For instance, the manufacturing cost of one computer of the global incorporation, manufacturing incorporation is 20,000. And a distributor sells the product for 60,000. Distributor sells the product for 60,000. Global distributors are located in the state where the low tax regime. So tax are not unique across the world. Some countries tax heavens are there. Some countries all the high taxes are there. Different taxes because today the public revenue, the government revenue is very important for development activities. So that's why some other countries lower tax is there because they want to they are giving a motivation to the prospective entities to start their business. So that's why lower taxes. Even within the country also, backward states tax holidays are there, or tax incentives are there, or transportation tax, or a hill area tax. So different concessions are also within the country is there. At the same time, different countries on the globe, across the globe, different taxes. Some taxes are lower, some taxes are higher. And if you see that global computer sets sub-market transfer price, they have started a sub-market global distributor in another country. Why? Because that country is taxing low tax. When compared to global computers situated in another country, that is a tax high. And global manufacturers with the aim to transfer the profit of the global distributors. Transfer the profit. The profit should come to the global computers, but they are shifting that profit to the global distributors. Global computers sets a transfer price 30,000. Slow global manufacturers sells the computers at a transfer price of 30,000 per computer to the global distributors. Whenever the manufacturer manufactures the goods, he is manufacturing for 20,000, but he is transferring to the distributor for 30,000. But now you see that how the profit comparison. Profit of the global manufacturer 10,000 per computer. Why he is getting that particular he is 30,000 minus he is selling the his cost of production is 20,000. His transfer price to the distributor is 30,000, thereby 10,000 profit. At the same time, distributors, they are getting the computer for 30,000, but they are selling the computer for 60,000, thereby the profit is 30,000. And low tax area, particularly global manufacturer is a high tax area, and distributor is a low tax area. So global manufacturers where the company is located 35% tax on profit, while the low tax is a global distributor, that is 25. Global competitors, in order to reduce its tax liability, transferring the profit of the entity to the low tax rate. In that case, how global manufacturers, they are getting profit. How much? 30,000 that transfer price minus the cost of production 20,000, 10,000 is a profit. In that particular company, the tax rate is 35%, 3,500. But a global distributors, they are getting the product for 30,000, but they are selling the 60,000. Thereby, the profit is 30,000. 30,000. They in that particular distributors company, the tax is only 25%. They are paying 25%. That is on 30,000 profit. 60 minus 30,000. That is 25, 7,500 per computer. Total the tax to be paid by the global computer. So that is the parent company on manufacturing company and distributed company put together is 11,000. That is 3,500 plus 7,500. That is 11,000. But without the transfer price mechanism, what should be the total tax to be paid by the particular company. Manufacturing of 20,000, selling cost is 60,000, the profit is 40,000. If it all are happened at global competitors place, and 40,000 is a profit, 35% is tax, 14,000. So instead of a transfer, they adopted the transfer price mechanism because some profits are shifted to the low tax regime, and thereby the total tax in the earlier situation is 11,000, in the current situation is 14,000, thereby the tax reduction to the global competitor is 30,000 on account of a transfer price mechanism, because they shifted some of the profit from a high tax regime to low tax regime by setting the transfer price below the market price. The market price is 60,000, but whereas they have the manufacturer transferred that computer, each computer, instead of 60,000, they have sold for 30,000 to save the tax. And then shifting the profits low tax region, global competitors, the parent organization pays fewer tax overall. But this is not correct. This is not correct, because the company is located X place 35% region, and to get the benefit, they are shifting to they have started one more entity in a low tax regime, and they are reducing the tax burden, but it is a burden to the parent company location country, because today every country they are trying to increase their public revenue, that is either direct taxes or indirect taxes, and whatever the loopholes are there in the tax system, that should be controlled or arrested. Otherwise how the country will do the particular welfare of the society? For construction of road or development of the country or barrages or airports or railway system, all are through public revenue only. If it is shifted and the companies are getting the benefit and the government exchequer, that profit is the revenue is reduced, the taxes revenue is reduced. Transfer price in foreign trade. Now we will discuss. This is an example how the corporates are doing this one, and that's why the direct taxes, particularly CBDT, they have introduced this system, and to arrest the loopholes, to plug the loopholes, to increase the revenue of the country in order to use for the development of the country. This is not only in India, across the globe, all countries are alert in this area, because some countries they are offering lower taxes. There is a large number of multinational companies, and they are in a position have been presence in multiple locations. Today, on account of globalization, world is single market, and do business activity virtually anywhere in the world. I can start anywhere on account of globalization. Anywhere I can start. And apart from global trade, which multinational companies, entities anyway do a significant volume of transfer of goods or services, not only goods and services, capital, and they are debt, equity, hybrid forms. So many things are there. ADRs are there, GDRs are there, global depositories, American depositories, external commercial borrowings. So many things of one country to another country, it is moving. And intangibles, particularly the property right, intellectual property rights are also using and developed in one country and using by the other country with a low cost, thereby benefit, tax benefit they are enjoying, taken place within a multinational entities group. All these things are happening. So that's why this is a lot of income leakage, particularly income means the government revenue leakage is happening. And to plug out that leakage, the transfer price mechanism in foreign trade DT purview has arise. These transfers within the group are called intra-group, within the group, and estimated that intra-group transactions in the range of 60% of the international transactions. If at all you see the international transactions, out of the total transactions, 60% are intra-group transaction within the group only. This is a lot of potentiality to increase the revenue base of the government. And it is observed that within the intra-group, transactions are intangibles, shared service also. Parent company is sharing the services to the associates or subsidiaries, shows a increasing trend contribute to substantial growing complexities. Understanding and analysis of such loss. That's why the cost accountants are most suitable for this type of assignments. Because what is the cost of production or cost of service or cost of operations? And all these things, they are well versed in this area. So this topic is more relevant to the CMS. To understand this become important in the context of determination of consideration. One parent company is giving some goods to the subsidiary or associate. Consideration. The consideration should be equal to the market rate, not below rate. Even though it is a related party, the related party transaction, it should be arm's length transaction. It should be arm's length. Whether it is a public or related the related party, the transfer price should be equal, not less. Determination of consideration during such a transaction, pricing transfer price, which in case of transaction between truly independent entities is determined by market process. Whenever I am selling the good to others, I'm always thinking about the market price, demand and supply gap. If a demand for the product is there, I have to charge more. But within the country, within the company, once I am transferring the goods or services to my entities or associates, the same logic, the same formula to be adopted. That is not happening. Thereby, the countries are suffering a lot on account of the shortage of the tax, shortage of the revenue. When the transaction takes place between the two unknown entities, it is entirely driven by the demand and supply forces in the market. But such transactions are affected within the entities, associates, holding company or subsidiary company or joint venture or other related parties. They are supposed to do it, but in practice that is not happening. Once I am selling the goods to a third party, same price I have to charge it to my associate, my subsidiary, the holding company or joint ventures, etc. Once that is happening, the tax revenue of the government, concerned government will increase substantially. That's why earlier, now arbitration is there, arbitrage in foreign currency. What is the arbitrage? Simultaneous selling and purchase of the goods, selling and purchase and selling. What is that one? If the price is low in one market, high in another market, I will purchase and sell in the. Today, the arbitrage is not happening on account of technology, on account of transportation. Earlier, the gold rate in Bombay market one rate and Chennai market in another rate. Today, that is not happening. Within the country, all markets same rate is quoting, more or less. So they suppose it to driven the market forces, but in practice, it may happen, it may not happen. May not happen. Incidents are increasing. That's why government is worrying about the revenue. Price mechanism artificially decided by the parent company. In the earlier cases also, global competitors, they decided the price. Instead of 60,000, they decided for 30,000. With a view to derive maximum economic benefits. Okay, everybody is thinking about a profit because all are commercial organizations. And a comparative tax advantage. The comparative tax advantage, they are always using that one. That's why this problem arises. This depends on different tax regulations and economies of scale of operations in different countries. Today, tax across the globe is not uniform. Some countries offering low tax, some countries are charging a high tax on the products. That's why the differentials are there. The differentials are encashing by the corporates. It is not a tax evasion. It is not a tax evasion, but they are using the opportunities. But it is a problem to the country because the country revenue is decreasing. Why no uniformity tax structure or rates across the globe? Across the globe, why uniform tax is not there? Different countries, they are following a different tax practices, but on account of differences are there, and some corporates or companies, they are using that opportunity to create an impression of liberalized economy. Actually, some other countries, they are giving less tax, charging less tax. Why? Liberalize. Once liberalized, the volume of transactions will increase. Then they will be benefited. Second one is to get good rating, easy of doing business. Today, India also, the easy of doing business rank is 63. And some countries, so particularly the number one country in the world is Singapore, easy of doing business. So to get why the company, some countries, they are charging lower tax because they want to get they get the rank, that easy of doing business rank. Soft regulations to invite the investors or companies from other country. Today in foreign exchange also, the non-deliverable forward contracts in particularly Dubai, London, and particularly the Singapore markets, non-deliverable forward. You can betting the foreign currency also, but that type of situation is not there in our country. You can trade foreign currency also, betting like a share market betting. This is also there. That is called non-deliverable forward contracts, NDF market. But in India, only forward contracts are there, no NDF. But on account of pandemic COVID-19, the Reserve Bank of India given permission to the banks to trade in foreign currency. Trade in foreign currency for the corporates, trade in foreign currency for individuals, not there in India. But it is there in Dubai, it is there in Singapore, it is there in London and different parts of the world. Because there are soft regulations. But our the regulator for foreign currency, that is regulations defined by the Reserve Bank of India, rules are defined by the Minister of Finance, they are not agreed. No, trading in foreign currency dangerous for the country because still the country is having its own problems. And to earn more through high volume of transaction. Once liberalized, transactions will high. Once the transactions are high, they will get some, even some countries, even though they are charging low tax, the revenue to the government is high because some of the companies, they are moving to that particular country to control, minimize the deficit position, balance of trade. And even India, the balance of trade is negative, balance of payments is negative. So to overcome that particular problem, some of the countries, they are reducing the tax and to increase the countries in foreign exchange reserves. One of the countries rating is forex reserves ought to be more. Once the forex reserves are more, the rating of the country given by the Standard and Poor, that will increase. Not only that one, deficit of the country minus in India, which are going to be they submitted by the Minister of Finance on 1st February. Deficit. Every year a deficit. The revenue is less, expenditure is more. The difference, they are buying within the country public debt or external borrowings from the World Bank or other countries like that. So here, to create more employment opportunities, once the tax reduced, then growth will happen. Number of companies, they definitely in that particular zone they will start. Once the number of countries are the companies are they started their business, employment opportunities, the GDP rate will increase. That's why in some parts of the world, some countries lower tax, some countries high tax. That difference on account of these reasons only. Some countries they are charging lower tax. If you see the tax havens country in the world, particularly Luxembourg or Malta or Bahamas or Jersey, all these things are Mauritius. These are called the tax haven countries in the world. The low tax we can enjoy, the less tax, but in India the tax is high. In these countries tax is nominal, minimum, and these countries also. So these countries are also the tax havens. So that's why some of the countries high taxes there, some of the countries low taxes there. It depends upon the government's policies and their growth rate, their forex reserves, their balance of a trade, their development plans. All these things are contributing a lot. That's why the differences are there between the among the countries. So it become relevant that the right price is fixed called transfer price. I should not transfer the product for 30,000. Even though my manufacturing cost is 20,000, I should not transfer for 30,000. I should transfer for 60,000 because that is the market price. But there the profit is less. That's why the particularly in that particular computers, global computers, they have transferred to another country for 30,000 and 60,000 minus 30 for 30,000 benefit lower tax they're paying. And inter unit or intra unit cross border transactions, buying or selling services include tangible and intangibles happening. Even transaction arising among the related parties must comply with the arm's length. Even though my subsidiary company is there, related party, my associate, related party, my joint venture, related party, even though it is a my own company, my associate or the entities, I should transfer whatever the prevailing market rate. I have to transfer that services or products at market driven rate, not the low rate. Arm's length. What is the arm's length? Suppose I am starting one company. I am selling the product for 20 rupees for the customer, but my relatives I am giving only 15 rupees. That is not arm's length transaction. Arm's length transaction means whether relative or public, if at all I am charging the same rate of interest, the same price. If at all I am charging interest for a public 12%, my relative 10%, that is not arm's length. If at all I am giving credit to the public 60 days, my relative 30 days, arm's length means not only the price, the discount, the period of credit, all these things are coming to the picture. Scenarios, this type of requires a right price mechanism called a transfer price mechanism. Whether it is within the country or with the inter company or intra group or cross border, arm's length price is required. But that is not happening. So that's why to plug out, that's why the CBDT, they are conducting the audits. surprise audits, and some the forms are also to be uploaded, online upload that forms. Liberalization and expansion of a business territory beyond the limits of the countries. Boundaries are decoupled. Today, to start a business, not only in India, abroad also easy. Because of globalization. If I know the rules of the business, law of the particular country, then I can start. Because on account of technology, information technology, Uber, that is not the corporate office is not at India. So that's why transportation. Today, to reach the product, any part of the country, earlier we used to the ships. Today, air cargos are also increasing. Transportation is not a problem. Across the globe, within a short span of time, the products can reach. Communication. Today, any part of the world, you can talk with the people with WhatsApp call also. Earlier, that is not the case. So you have to book the international call. Today, there is no question of international call. Earlier, the fax mission. Today, the fax is also not required. So that's why, on account of a liberalization expansion, that's why some of the companies they are expanded their business cross borders. Flexibility to place anywhere. I can start in Sri Lanka. I can start in anywhere. I can start enterprise. Any part of the world lead to increase the number of cross border transactions. That's why the cross-border transactions, the amounts are also routed through SWIFT, SWIFT, Society for Worldwide Interbank Telecommunication. Country to country remittances are routed through SWIFT only. Within the country, RTGS and NEFT is there. Real-time gross settlement or national electronic funds. Country to country, SWIFT. The transactions are tremendously increased. If you see the SWIFT website, transactions are tremendous. Enlarges the scope, exploit the differences between domestic tax system, resulting the ultimate reducing the tax impact. So always the promoter, it is a commercial business, not a charitable business. Always he is thinking about how to minimize the tax, how to maximize the dividends to be paid to the shareholders. The challenge is shifted to profit to high tax regime of the country to low tax regime of the countries are relevant for the countries to draw a global capital, favorable manner, environment, offer easy of doing business. Today, business means I have to satisfy all the stakeholders, not only shareholders, the employees, the government, all the to be. Then I have to earn profit. It is not a tax evasion system. Economic reason for charging transfer price for intra-group transaction able to measure the performance of individual entities in a multinational group. If at all I floated a different entities, each entity should earn some profit. Otherwise, I have to close down that entity. Individual entity with a multinational group are separate profit or cost centers, and a transfer price are required to determine the profitability of the entities. Rationally, an entity with a view to own interest distinct from legal entity would acquire products or sell to a related party equal to or cheaper than the price charging to unrelated. Today that is happening. Unrelated party one price, related party less or equal. So that is a contravention of the opposition of that particular. They should charge a higher or equal when the goods are selling to unrelated parties. Whatever the price you are charging to unrelated party, the same price to be charged to the related party also. Price should tend the base to arm's length price only to unrelated parties. The transfer pricing is multinational entities do not perceive the tax avoidance or evasion. Their main objective is not to avoid the tax. Whatever the benefit is that they are using, but it is a disadvantage to the country. The revenue is decreasing. The natural resources of the country they are using, but the tax is low. In other country, that's why they are moving the goods to other country. From there, the profit they are showing in the other country, they are paying less tax. But tax authority rightly concern transaction between the related party entities, same group are not carried at arm's length. Such a pricing methodology of the lower revenue. With the pressure on increasing tax revenues, today subsidies are there. Below income people, some amount to be distributed for their welfare, or health insurance at a free cost, or the law and order of the country, all have to be safeguarded. But a government revenue should be increased. So here, one opportunity is there to the country also to plug out the leakages of income, leakages of revenue of the country. Mounting tax authorities look at effective revenue mapping exercise. They are doing the effective mapping revenue exercise. When it comes to transfer pricing, key incentive is that soft target produce very large increase in the tax revenue with little efforts. Once I have verified the transfer price it is correct, then automatically I need not bother. If not correct, I will separate the transfer pricing accordingly. The tax I can get it. With a small effort by the government, they are increasing the revenue. That is the aim of the transfer price mechanism in foreign trade, particularly under DT purview. So this is not a new concept. This is not a new concept. Historically, this is a long back it was introduced. One company is in one country started and they are using, they are floated other subsidiary company or another entity in other country, and they are transferring the particular goods, and they paying less tax in other country, and high tax countries they are losing the revenue. That's why it was recognized by all the countries across the globe and India also. So the historical background, once I told all these things, then you can get a fair idea about the transfer price mechanism. Later on, I will discuss how to audit, what is the price mechanism. All these things we will discuss in one more class subject to approval of the taxation committee. Historical background. History traces the first transfer pricing legislature in UK in 1915, with the USA following 1917. This is not a new concept, but this is an opportunity. In emerging country like India, this is an opportunity. And why? Because the cross-border transactions within the cross-state transactions are also increasing tremendously. Main intention to introduce the provisions was to discourage the companies to shift the profit to overseas associates through underpricing or overpricing of cross-border transactions. Underpricing or overpricing. Even overpricing also. That is also I will discuss. In UK, in 1984, introduced a new anti-avoidance legislation called the Controlled Foreign Corporation. Controlled Foreign Corporation rules. These rules provide profits accumulated in offshore subsidiaries should be attributed back to the parent company. No. Whatever the profit earned by the particular your entity is there in offshore, that should be back to the parent company. But the provisions did not include the cases where offshore parent company charged higher than the arm's length price. ALP means arm's length price from the subsidiaries. In the period 1960, countries started laying emphasis on the detailed rules. They counter the device of the shifting profits from one legislation to another, reducing the tax impact. In 1960, after 1960, countries started. Why the company, parent company is located here, they are floated other company in, and they are transferring this particular through transfer price mechanism. They are transferring and they are paying less tax in other country, and the parent company located country also, they are not receiving substantial revenue on account of that particular company. The period 1970 saw many developed countries trying to develop expertise in transfer pricing. Matters upright prevailing law to deal with the transaction routed through tax havens. Tax havens means low tax regimes. That's why it is heaven. Why it is heaven? No, the tax is very less. Happy. Corporates are happy, individuals are happy, they enjoyed a lot, and their income levels are increased on account of government low tax. But government is, if at all they have not charged low, nobody will come. But some activities, their income will increase. The volume of transactions on volumes. Today, most of the companies, they are getting the profit not on units. They are getting the profit on volumes. Earlier, even particularly the electronic shops, for TV, one TV per month, two TVs they will sell, and they will get only 5,000, 5,000, 10,000. Today, that is not the case. They will sell 60 TVs per month, and each TV they are expecting a profit of 1,000. So the law of demand is there. Once the price of the product decrease, the volume, the demand for the product will increase. Volumes, they will attack the volumes. So that's why some other countries, they are charging less, means to encourage other people to use that particular country, and thereby employment opportunity, GDP growth, the foreign exchange trade, reserves, all these things, it is a positive. It doesn't mean that they are giving concession. They are not at all giving concession. If that is not there, they don't get anything. Rooted through tax havens, when simpler and conventional provisions could not be made applicable. The Organization for Economic Cooperation and Development, OECD, that is a group of countries, was established in 1961. The OECD, that is the Organization for Economic Cooperation and Development, at present 38 countries are members of the particular OECD. India is not the member. OECD undertook depth analysis of transfer pricing. They also did because the 38 countries should not suffer the revenues. Whatever the eligibility is there, they should not suffer. On account of shifting the transactions to the lower tax regime, they are suffering a lot. And that's why they started depth analysis, transfer pricing provision, and published a report of transfer pricing and multinational enterprises in 1979. I'm talking about the history. In India, one of the many non-member economies, particularly for OECD, has a working relationship in addition to member countries. India, even though they are not member in OECD, but they are supporting a lot for developing the models to overcome the problem of the tax, decreasing the revenue of the government. The OECD has cooperating with India since 1995, but still, even today, India is not the member. But India, whenever some judgments are there in various courts on account of a transfer price mechanism, and whatever the OECD guidelines are there, they are adopting also. In India, the key partner country actively participate in various committees, even though India is not a member in OECD, but we are participating in their committees, workshops, whatever the workshop they are conducting, and working groups of the OECD. But we learned a lot on account of this. Even though we are not the member, still we are participating. The OECD and India has enhanced cooperation in dealing with the issues related to transfer pricing and promote better tax compliances in order to improve the prevention of cross-border disputes. Country to country, cross-border disputes are arising on account of transfer pricing. On account of OECD and India enhanced their cooperation, this was a prevention of the cross-border disputes to a large extent. The prescribed three standard method computing arm's length price, namely comparable controlled price, realizable sale price, cost plus mentioned danger using the basis of determining the ALP, arm's length price. In 1984, OECD published one report also in this regard. So the intergroup services dealt with the treatment of interbank interest and other issues are also, that is also loans are taken by the they even today Japan, the rate of interest is very less because the inflation is also less. But in India, the rate of interest to be charged to the borrowers is on an average it is 12 or 13% like that. But in Japan, negative rate of interest. Negative rate of interest. So once you have deposited in Japan, they will charge interest on your deposits. But in India, they are giving some interest. But if you take real rate of interest, what is the real rate of interest? The rate of interest minus inflation is equal to real rate of interest. Today, if you take the inflation is 6%, banks are paying 6.5 on fixed deposit. The banks are real rate of interest paid is 0.5 only, not 6.5. Because today rupee is not equivalent to after 1 year rupee. So all these things are there. OECD reports published in 1987, 88, 94 dealt with the problem relating thin capitalization. What is a thin capitalization? Suppose I have parent companies here, but a low the tax rate regime country, I have put a small amount of capital and the turnover is more. Because I want to enjoy that taxes. That's why I'm not invested more in that particular country, but in parent country, I'm investing more. Tax consequences of foreign exchange gains and losses, income permanent establishment, all these things. With the practical examples and all these things, how to arrive the pricing, what are the various audit, all these things, practical point of view also we will discuss in the next class. OECD guidelines published in 1995 represent consensus among the OECD members, mostly developed countries, and largely being domestic transfer pricing regulations. Transfer pricing is not only between the two countries, even within country also. Some states, no taxes, zero taxes. Northeastern states in India. To develop the northeastern states, that is seven sisters, the government is giving a lot of concessions, subsidies, tax holidays, transport subsidy. So many they are offering. But to avoid that even within the country also, the tax structures are different from state to state. Transfer price regulation India. Okay, that history we have done in India also. What type of this one is there? After that, we will give some overview. The transfer price regulation introduced in India year 2001 in order to prevent the erosion of Indian tax base. That is the main objective of the transfer price erosion. The revenue of the country is decreasing like anything because the production is increasing. The tax they are not paying on account of low tax regimes are there. Indian regulation, transfer regulation contained chapter 10 of the Income Tax Act 1961 under the special provision relating to avoidance of tax. Under the chapter 10 of the income tax only, this was defined. So earlier, what OECD and UK or USA or 1961 onwards, the people, the countries are focusing on a transfer price mechanism. But in India also, it is introduced in 2001. Why? The main object is to prevent the erosion of Indian tax base. Finance Act amended, Income Tax Act 1961, amended section 92 of the insertion sections 92A to 92F, providing determination of proper income arising the income international transactions. So if you see the 92A to 92F, all are dealing with the international transaction. Either both the parties involved in happen in non-residents. Accordingly, section 92 to 95, 92F, transfer pricing provisions have been first introduced by the Finance Act 2001. The law relating transfer price is very dynamic. It is not a static, based on the experience, based on the people's their strategies to reduce the tax payment, and what are the best practices that are followed by the other countries. What are the best practices that are adopted by OECD countries? All these things are to be taken into consideration, and accordingly, we have to modify this one. That's why the law relating to transfer pricing is a very dynamic. The Finance Act 2012 has made significant changes. They have introduced the advance price agreement and a transfer of a pricing officer's power, and penalties are also introduced. In Finance Act 2012, changes were happened because the tax revenue is decreased. Government is worrying. And the companies started here, corporate tax is not getting, and they are using the other countries to pay the lower tax. Also, new section 92BA is also introduced. Covers the certain specified domestic transaction within the ambit of the transfer pricing regulation. So 92BA also introduced. These provisions read with the relevant, they are also defined the rules also. And what are the rules? Rules particularly 10A to 10T of the income tax rules. Also stipulated what are the records to be maintained by the companies with regard to transfer price mechanism. And keeping of information, what type of records are to be kept for verification, for audit purpose. And a documentary by persons entering into the international and furnishing the report by an accountant. if the volume of transaction touches or crosses the threshold limit. Certification is also required. They have to be verified. They have to be certified. And once the threshold limit, what is the threshold? I will discuss in the later case. With effect from 1st April 2013, the transfer price regulation were extended to cover specified domestic transactions. Even for domestic transfer, also one company to another subsidy within the country boundaries. I'm not talking about the other countries. Other countries, the parent company is in the particularly India, and the the company is another country. No, within the country also, parent and subsidiary, the transfer, because from parent to subsidiary are different types of services or goods are, that's why they have defined that 1st April 2013 domestic transaction. For a domestic transaction also they define. Over the past 2 decades, regulations evolved in order to catch up the global and the local developments. So locally and globally. Because within the all subsidiaries, entities, joint ventures are within the country, moving of goods from one parent or one entity to another entity, for that also the transfer price mechanism is very important. It is not only for the foreign trade but also local transactions. That's why they have introduced domestic transfer pricing regime, advanced pricing agreement program in 2012 they have devised, and the safe harbor rules defined in 2013, and multiple year data, how much data, the master data to be kept by the company, and the range concept, benchmark analysis, all are defined over a period of time. Not only that one, three-tier transfer price document structure as per base erosion profit sharing. Base erosion profit sharing, that is also they define. Action plan in 2016, and secondary adjustment provisions limiting interest deduction for thinly capital companies in 2007 are the examples of evolution of India's transfer price regime. It is not overnight. It is over a period of time. The evolving is also happening. So once you go through this particular information, then you will become a master in this area. This is not a rocket science. This is a simple science. Being a cost accountant, it is not a difficult task for you. The Indian regulations recognize arm's length principle. No question whether you are transferring the product or services to your entities. It should be market driven rates, not low rates or high rates. And require income from international transactions, specified domestic transaction be computed with arm's length price. It should be arm's length price. The Indian TP regulation do not make mention of OECD TP guidelines updated in January 2022. They don't mention because we are not members of that particular OECD. But as a part of a G20 group, G20 nations group, India played an active role in the OECD project for prevention of base erosion profit sharing. Shifting. Profit is shifting from one country to another country and is committed to the outcomes of a BAPS project. because we have the active role. G20. Next year, G21, one more country added in the group of that particular group. However, TP legislation India broadly based on OECD TP guidance. If at all you compare the OECD and the transfer price guidelines of India, more or less same, but we have not copied. We have supported, we have interacted, we have participated in the webinars, and whatever the best principles are there, we are adopting in our country also. The contents of three-tier transfer price document structure. For this, the transfer price documentation is a document numbers are there. Documents are to be electronically uploaded to the income tax authorities, CBDC. Transfer price methods are also there. All these things we have to follow, and broadly their guidelines, our guidelines are one, and the more or less 110% decide other side. Both the taxpayers and revenue authority are placed a reliance on OECD. TP guidelines, especially cases guidance is not available under the domestic legislation, particularly with regard to disputes. In case of legal issues, we are guidance is not available. Wherever guidance is not available, we will follow that one only. Similarly, principles laid down in OECD TP guidelines have made reliably several judicial rulings in India. So some of the cases are filed with the judicial authority for dispute between the taxpayer and the tax authorities. Then the court authorities, they will follow the OECD guidelines also. Several judicial rulings, whether appellate authority or they wherever possibility is there, they will use that OECD transfer price guidelines. Now, a simple overview of transfer price methods. What is the transfer price methods? The Indian transfer price regulation prescribed following 6 methods for determination of arm's length price. One is a comparable uncontrolled price method. Second one is a resale price method. Third one is a cost plus method. Fourth one is a profit split method. Fifth one is a transaction net margin method. And the last one is other methods. For transfer price regulations, 6 methods determination of the arm's length price. But out of this, the 6th method, other method, has been prescribed by the Central Board of Direct Taxes. As any method which takes into account of the price has been charged or paid or would have been charged or paid for the same or similar uncontrolled transaction between the non-associated enterprises under the similar circumstances, considering all the relevant facts. The CBD is prescribed. The 6th method, other method. What are the different methods? We will discuss later on. There is no hierarchy in the selection of methods, whether to go for first method or second for that, after that this, no. And the most appropriate method can be any of the 6 prescribed methods. But 6 is prescribed. It doesn't mean it is not obligatory to follow the method, 6 method. The Indian TP regulation do not have self-assessment regime. Taxpayers who have entered into international transaction for a domestic more than 200 million with their associate entities have to be reported certified by and from an accountant being an independent accountant prescribed form 3 CEB. Whenever they are entered in any international transaction, with their entities, associated entities, that is to be reported in Form 3CEB. That is to be certified by the accountant, most probably chartered accountant. The independent accountant has to certify inter alia what is the nature of transaction, whether it is international or specific domestic by the taxpayer, quantum of such a international or specific domestic transaction as per the books of accounts, arm's length value of that international or domestic transaction, the method considered to be most appropriate method, that is to be certified by him. That is to be certified by him under 3CEB, form number 3CEB. The taxpayers are electronically form number 3CEB certified. The due date for electronic form is, if at all it is closes by, financially closes by 31st March 2023 for the financial year 2022-23. So the particularly 31st October is the last date. For this, the CBDT is the apex authority of the revenue department charged with the administration of the direct taxes. So that's why the functions of CBDC include setting up a structure of the revenue department, laying down the policies, procedure of work, administration, laying down the policies framework for all matters of the tax policy, and legislation and implementation of the revenue authority issuing director notification, all these things with regard to transfer price mechanism, the CBDC. So this is that's why here the experts in this area also very limited. We are talking about stock audit. We are talking about cost audit. But beyond all these things, this is also one of the good opportunity for the CMS, because the CMS are experts in arriving the cost or arriving the cost of operations or services. And in my personal opinion, they are most suitable for this assignment. To conclude, identifying, characterizing, benchmarking, comparing, and ultimately validating the arm's length price for any organization in international transaction makes a transfer pricing a subjective proposition where no two experts may always be same view. If at all I am audited or I am verifying or I am preparing the books, or my view, your view may not be synchronized. That's why the problems are also arising. Some of the issues are the disputes are arising. Thereby, the courts are also intervened in this area. So, identifying the transaction, characterizing the transaction, benchmark, comparing, ultimately validating arm's length price in an international transactions makes a transfer pricing a subjective proposition where no two experts may always be the same view. They are not the same view. Driven conflicting consideration of the taxpayer and the revenue authorities. Taxpayer argument is one thing, tax authorities argument is another thing, and becomes very complex scenario. This is a complex scenario. Convincing the revenue authorities is also a art. Perhaps explaining the reasons for significantly large volume of litigations on this subject. Not only that one, international transactions takes place, particularly the purchases and sales, either it goods or materials or plant and machinery or loans and advances given or taken or transfer of technology or royalty or technical fees or management consultancy fees or reimbursement of fees or reimbursement of expenses or giving and taking premises on lease or various services, all are linked to the transfer price mechanism. The transfer price mechanism should be arm's length only. And that is very important. Not only that one, relevant information should ideally be traced. Once you are the particular person who are preparing or who are analyzing or who are they brought to the notice of the tax authorities or revenue authorities, proper records of the company, particularly with regard to the transfer of products from one entity to another entity in the group of companies, particularly foreign counterpart, are associated into details of information on international transactions, functions, asset and risk analysis, and commercial and economic analysis, selecting correct base of international transaction is a art as well as science. It is an art as well as science. The science is the rules and regulations that are framed by the revenue authority. Convincing the tax revenue authority is also very much required. So the relevant information is to be traced from the records of the company. But with the advent of the technology increases like anything. Even minute level also, granular level also, data can be analyzed with the help of various tools that are available, particularly the technology, the software, even Excel, or we look up so many things, particularly the technology. More amendments in transfer price provisions are also there. But today it is very easy because GST is there. Provision set of information utility under insolvency, IBC code. Under IBC, one more institution was also formed that is called information utility. So whatever the data of that particular corporate is there, that data is also to be uploaded in the information utility, particularly with regard to the loans and advances. Borrowings from other country or lending to the other countries, all are to be recorded in the information utility. In that case, transfer price mechanism is not a rocket science, it is a simple science. But we should know what is the methods, how the company, how to audit, what are the areas to be audited by the tax authorities, and all these things. And expected to significant part of transfer price challenges will be addressed arising of reduction in asymmetry in information in the public domain, which is typically challenge faced by the entities, including the SME sector also. Even today, the exports are increasing to by the SME sector. For all these things, definitely, if CMS are expertise in this area, in my personal opinion, the opportunities are plenty. The expertise in this area is very less. So today we are talking about the cost audit or the particularly stock audit or various types. But in addition to that, this is also a good opportunity. Mastering this subject, it is not a big and big sum. It is not a too tough subject for you. because on account of your knowledge, particularly in arriving the cost of a production or services, and transfer price mechanism also. So many some in it was covered in different subjects at the final or other. So that's why this is one big opportunity for you, and please explore this opportunity. And this is one of the important opportunity that is available in the market. So with this, thank you very much for your patience listening for the last 1.5 hours. And this is in brief about my the subject, particularly the transfer price mechanism in foreign trade, etc. So thank
Sir,
you very much for giving an opportunity by the taxation committee to discuss about the basics of a transfer price mechanism. Thank you.
sir, we have a few questions, sir.
Tell
We
me,
have a
madam.
few questions, sir.
Tell me, madam.
Which is from Srinivasa Reddy. If a company, for the sake of determining the transfer price, it transfers small quantity to a non-related person, and the same price is used for intercompany transactions, how the department determines the transfer price in such case? When the product is an exclusive product, no similar product or similar features are available in the market.
But actually here, for determining the price of the two different products and different entities, we have to go into the depth of that particular the what is the cost, why they are selling at different prices, and different entities. All these things we have to study, madam. Then only it is they we have to make a conclusion. Otherwise, simply based on that, without the data, it is somewhat difficult to approach. We have to imagine what is why they have the different prices, or the different entities, why the company is selling the products like that. All these things we have to study in detail. Then only we can give the decision.
Sir, we have one more question.
Tell
It
me,
is
madam.
said that in the presentation, you have taken an example wherein a global distributor is selling a computer at 60,000 rupees abroad. But supposing in India, the place of manufacturing, the market price is rupees 50,000, and moreover, some extra costs will be required to be incurred as overseas transportation, selling and distribution, and finance costs, etc. Now, how the transfer price consideration will be fixed and whether these extra costs are already considered in the 20,000 costs taken in your example.
Only I have given only rough example, but all these things are also to be taken into consideration. I have given only to get a fair idea or rough idea about how the different countries and different tax structures are there, how the parent company is benefiting on account of this one. Only for a small example I have told, but in depth subject, a lot of points are to be discussed in this subject also. It is a very not very easy to understand. Some other people, they may not understand about the transfer pricing, particularly domestic as well as international. For that sake only, I have given a small rough example. All these things are to be taken into consideration. Whatever the additional costs incurred, all these things are also to be taken into consideration.
Okay, sir. Sir,
Okay, madam.
another
Tell me.
question we have from Mr. Jitendra Rao. He says, is it appropriate to link cost audit with transfer pricing audit? Do we need to take it up separately?
But that is to be taken up with the government, particularly the CBDT.
Okay.
That is to take up by the particular committee to with the CBDT authorities.
Okay, sir.
That
So we do
that
not
is
have.
actually that is a good point. This is an opportunity also. this is an opportunity also, because the cross-border transactions are increasing, the exports and imports, and within the group also the transactions nearly 60% are there. This is the right time to made a request to the appropriate authority to start the transaction, particularly the transaction transfer pricing mechanism audit also.
Okay, sir.
So thank you very much, madam, for giving me an
Thank you, sir.
opportunity to discuss about this basics of transfer pricing mechanism. And I wish you all the best to all the participants, and thanks to the committee also. Thank you,
Thank
madam.
you so much, sir. Thank you so much. We end the session. Okay, sir. Thank
Okay.
you. ঠিক আছে শেষ